Yep, we're live.
We're live? Okay, great. Uh, Thank you everyone for joining us here on YouTube Live. This is the Retire with Style podcast special edition with myself and Alex and Bill Bengen, who was on the podcast this week and who's joining us now to answer your questions live with a live Q&A. Bill, thank you so much for joining us.
Wade, thank you for the invitation. It's fun being here.
Oh, and it's our pleasure to have you. And I see the picture of your book behind you there, and I have my own copy as well, A Richer Retirement, Supercharging the 4% Rule to Spend More and Enjoy More in Retirement. And we're going to focus on questions that do relate to the topic of the book, which is really about the whole safe withdrawal rate type of question. We did get some questions in advance, and a couple of those were on different types of topics, like building a time segmentation strategy with bond letters, that sort of thing. We'll hold off on those types of questions today. We'll really want to focus in on questions related to total return style, safe withdrawal rate, spending from a retirement portfolio. In that regard, we do have 7 questions that came in advance, and we will monitor the live chat to get to your questions. It's a great opportunity to ask Bill anything on your mind, again, related to the safe withdrawal rate question. And Bill, let's go ahead and get started here with the first question. Based on our discussion in the podcast, someone wrote, if Bill sees inflation as a primary risk in retirement, would it be wise to allocate some of those intermediate term government bonds into TIPS instead, Treasury inflation protected securities?
And the answer is yes. I think it definitely makes sense. It probably makes sense to have them almost all the time as a permanent allocation in your portfolio. But particularly now with inflation being kind of dicey, I think they look particularly attractive.
Bill, you had said just because I didn't fully, it's good to have them all the time as a what?
Permanent allocation.
Oh, permanent. Okay, gotcha.
Yeah, that's right. I don't include it in my book because I haven't been able to develop a background, a story for the asset class going back 100 years. But in time, I think I'll be able to work into that.
Yeah, TIPS have only been around since 1997, and trying to estimate hypothetical TIPS before that requires some guesswork.
Yeah, I would think so.
That's probably the issue. Great. So and that I think you also addressed in your book and also on the podcast, that you look at these 7 asset classes, but that may not be the whole story. So if someone's thinking about TIPS.
Yeah, that's right. I would think most people would have a lot more than 7 asset classes in a portfolio, including REITs and gold and commodities, maybe alternative investments, emerging market stocks, and so forth, all worth your attention. Improve diversification.
Great, thank you. So question number 2 that came in advance, is the 4% rule still a constant? I've seen it taken as low as 3% due to increasing life expectancies, or does it vary depending on market conditions, etc.?
Okay, it's really important to recognize at the outset that the 4% rule was never intended as an immutable rule, something that'll never change. It's not like E equals MC squared or Newton's laws of motions, which we expect will be around forever. The withdrawal rate, in fact, has been higher in the past, the safe withdrawal rate. It was determined currently by the 1968 retiree, 4.7% is that number. But if you look at, if I was to do my research back in the 60s, I would have come out with a higher number because we hadn't got into that terrible period of the 60s and 70s yet. As far as low end 3%, I don't see anything in a historical record that I have that would have required a withdrawal rate that low, even as recently as 2008 or something, with that terrible bear market. And unless inflation takes off to the upside, I don't think we need to be concerned about going that low.
Okay, and maybe the corollary to that question, if someone was thinking about a 40-year baseline retirement instead of 30 years, I think getting at that idea of life expectancies, what kind of impact do you see with extending the life expectancy that way?
Yeah, absolutely. If your planning horizon expands, you have to take your withdrawal rate down with it.
But not to a significant degree, I think, when we're talking about that type of length.
Yeah, no, it's very comforting that just the way the mathematics work out, that as you get to very, very long life expectancies or planning horizons, it stops dropping. It hits a floor and doesn't get much lower, the withdrawal rate. So if you want to live 200 years, here's more power to you.
Okay, great. Next question that came in advance, and we'll monitor the live chat as well. Research on withdrawal rates seems to favor that the accounts are being utilized are qualified. I don't get it. If I'm trying to withdraw $40,000 before taxes, isn't it the same whether or not I'm withdrawing from a qualified or a non-qualified account? $40,000 before taxes is the same $40,000 regardless of account type. So why the disclaimer?
Yeah, that question is making a reference to some comments possibly by someone else, which I'm not familiar with. In my work, I agree with the questioner that taking money out of a 401k, no matter what its status, probably doesn't make any difference.
Yeah, maybe another comment to add to that as well is just with the taxable account, the question's right. If you take $40,000 out, at that point, it doesn't matter what type of account you're taking it out of.
Right.
But getting to that point, with a taxable account, you do have the ongoing taxation on the returns, the interest and qualified dividends. And so that eats away at the growth of the account over time. So that would be why the disclaimer is important.
Yeah, I agree. I think probably the equalizer there is that the taxable account pays taxes as it goes for income, dividends, capital appreciation. But the IRA account does not. So if you look at net after taxes, including taxes on withdrawals from IRAs, probably the total net amount left over is about the same from both types of accounts.
Okay. Wait, I've just because when it's something you said sparked a question for me, and we're starting to get questions live, so we'll go over it. But
Terrific.
Let me ask my question right now, because I'm curious what your thoughts are, Bill, in terms of you spoke about if you amplify the asset classes within your portfolio, obviously you can get more upside. Well, what would your response be to somebody that says, hey, look, I've got 3 stocks, small cap, 3 stocks, large cap, 3, more of a stock picking approach that's very concentrated in a few stocks, saying, hey, I'm going to take 4% of this and this should be a good thing. What would be your comment on something like that?
Well, following a riskier investment strategy, which is completely contrary to the index passive approach that I use in my book. So it's really hard to assess. Depends upon whether they're the new Warren Buffett or
exactly
or pretender. If they're the new Warren Buffett, they can probably take out 26%, do just fine. But for most people, picking individual stocks is difficult. Not that it can't be done, but it's challenging and it's also risky.
Okay, so yeah, I was just curious. The person who's sitting on, let's say, 5, 6, 7 stocks, thinking, "Oh, I'm going to take 4% from here, and I should be golden based on this book that I just read."
Well, yeah, I just think that's a risky approach, particularly if you got the Mag 7 stocks.
I just wanted to hear it from your mouth, not mine.
Yeah.
From that perspective. Wade, you want to go into some questions? We got Johnny D with one.
Yeah, I do see that. I was in the wrong chat before, so I do see the live questions coming in. So the first one from John, a small cap may not perform well in the future due to flight to venture capital, private equity, and need of profitability filter. Isn't the safe max up to 4.5% from adding small cap overstating the future safe max?
It's a fair question. Small caps are clearly in a period of transition. And yes, equity, private equity and venture capital is becoming more important, and they tend to drain off some of the best small companies before they get to the mutual fund world. However, I'm not willing to give up on those small caps yet. They've had cycles before where they've greatly underperformed large caps, as they have over the last decade or so, and then come back and had dramatically good performance. So I think the jury is out on that. I'm not changing my allocations yet. I suspect small caps are entitled to a nice run here.
Okay, great. And Tony asks, Bill, your original 4% rule gave retirees a simple benchmark, but your newer research suggests we may safely draw closer to 5%. If we're now in an era of higher inflation volatility and longer retirements, how would you redesign the first-year withdrawal rule to reflect both longevity risk and personal inflation rates without overwhelming the average retiree with complexity?
Sure. The two most important factors in determining your number, your withdrawal rate, are the inflation rate for the first 10 years of retirement and also stock market valuation. The idea being that if the stock market is very expensive, we're probably not very far from a major stock bear market. Major stock bear market early in retirement is always associated with low withdrawal rates. So that taking those two into account, if I was retiring today, I'd probably be looking at somewhere around 5.5% for 30 years from a tax-deferred account, which is a lot better than the 4.7%. But then again, we're not faced with the dire economic circumstances that were present 50, 60 years ago.
Okay, great. And maybe a follow-up question to that while we're still on the topic of inflation from A. Castles. With current inflation, you discussed a 5.5%, what you just said, as a reasonable withdrawal rate for starting retirement now. If inflation pops up like it did during COVID, how would you recommend adjusting?
If inflation does appear to be a problem, I recommend reacting immediately by cutting, at least temporarily, your expenses until the storm blows over. We had a storm like that 3 years ago, where it got up to 9%, but it blew over. So although it affected the portfolios, it was nowhere near as devastating as the decade of high inflation in the 1970s. So yeah, I think you need to react to inflation defensively almost immediately, but be prepared, to raise your withdrawals when the storm clears.
Okay.
And when you say react immediately, you're speaking not necessarily of the allocation. You're speaking more of the distribution amount.
I'm sorry. Yes, absolutely. Yes, absolutely correct. What you're taking from the portfolio doesn't reduce stress on a portfolio.
Okay.
Take less for the time being if you can do so.
Okay, I think this next question is on the same theme as well, and it's actually from somebody who has clearly read your book, and so it may require a little bit of background to explain to the audience what the question means before answering it. But Calawish is asking, how bad of a deviation does there have to be for the current withdrawal rate from the synthetic withdrawal rate to have to change course in the amount of your retirement withdrawals? And that is something covered extensively, what these mean in your book, but we didn't even broach that topic on the podcast. So if you could explain what's meant by current withdrawal rate and synthetic withdrawal rate, and then how do you think about when those differ from each other when you actually make the adjustment?
Yeah, that's a great question. Current withdrawal rate is just simply your current year's dollar withdrawals divided by the starting value of the portfolio of that year. In the first year, it's what we call safe max, the safe withdrawal rate. It's identical because the first year is the first year. After that, however, losing my train of thought here a second. With respect to inflation increasing, just remind me the question.
Just repeat the question, Wei.
It's the one about, so you talk about the synthetic withdrawal rate charts in your book that kind of give you a course of where you want to be around, but then the current withdrawal rate might deviate from that. And what kind of deviation would trigger you to make some change to the plan?
Synthetic withdrawal rate is an arbitrary hypothetical curve showing what the current withdrawal rate should be each year during retirement, based upon a very simple average return and average CPI figure. And you can compare that against your actual current withdrawal rate. There will be deviations, almost certainly, because the synthetic curve does not experience bull markets, nor does it experience bear markets. So that what you'll have to do is make a decision if the deviation is due largely to a bear market that you're experiencing. I wouldn't do anything. I'd wait maybe 4 or 5 years, and you'll probably see, as happened in the past, that your plan will get much closer to the benchmark over time because of the stock market recovery. If it's due to inflation, though, it's once again in a matter where I think you have to act and be prepared to cut back severely if it looks like there's going to be persistently high inflation.
Yeah, and that, I think you have several case studies in the book about that. And I think that's really emphasizing maybe the point here of bear market deviations don't necessarily cause you concern, but it's if inflation ends up higher, that's where you really talk about potentially.
That's the greatest enemy. Yep.
Okay. Great, great. We do also have a question from Mr. Dennis. So if we review the plan on an annual basis, it would seem that the amount of the 4% withdrawal would vary widely depending on the market return. That seems contrary to the idea of the safe withdrawal rate. And I think there maybe he's thinking of 4% as in what you call the fixed percentage strategy rather than the inflation-adjusted spending COLA strategy. So
sure.
to be clear what that question's asking.
You know, if you start at a 4% level, let's say withdrawals, it will fluctuate considerably due to market conditions. Bear markets will drive it down, bull markets will drive it up. That's normal to be expected, and the important thing is comparing it to your benchmark, what your expected return is. And if it's within a distance of that, or if you know there's a reason for it that's going to take care of itself over time, there's no need for any action.
I'm not 100% certain on that response to the question. It could be I'm misinterpreting the question. Fine. And the way I'm reading the question, I think he's a little off, Wade, right? In terms of, not you, but the question. I think the person asking the question is thinking 4% of the portfolio every year, as opposed to 4% in year one. That sets the nominal amount, and then you adjust for inflation going forward. Yeah. Right, Wade? I think he's the person asking the question is going like that.
It's that general confusion. Sometimes people misinterpret what 4% means in the context of the 4%.
As I just did.
So, no, but you'd be surprised how often that happens. And that's why I want to kind of like level set.
Yeah, I like that.
I want to level set with the person asking the question that if you're taking a percentage of the portfolio every year, then fine. You know, what this person is saying makes sense. But in the nomenclature of retirement income planning, when you say the 4% rule, you know, thanks to Bill, it's taken as for whatever percent the first year is.
Year one.
And, you know, $100, you're taking $4 year one. And then every year thereafter, it's adjusted for inflation, that $4. Mm-hmm. And that's why you're getting at markets recover, but inflation kind of is more nefarious over the long term. And that's the biggest killer, because then that's why you're increasing, let's say, in high inflation environment, your distribution.
Yeah.
Did I clear things up, Wade, there, or did I convolute it even more?
I think that's okay. Yeah. If you are taking 4% of what's left each year, you have volatile spending, and so you don't. That's not really a safe withdrawal rate question. But Bill, maybe you compare the two strategies in the book. What do you find generally about the COLA approach, where you increase spending each year for inflation, versus the fixed percentage approach, where you let spending fluctuate fully in response to market performance?
Yeah, and it doesn't generate as much income during retirement as the COLA scheme, the fixed percentage scheme. However, it has the virtue of you never run out of money.
Yeah, I mean, that's like good news and bad news, Mrs. Lincoln.
That's what you have to worry about. You know, you may take a 30% cut in expenses one year, but what the heck? You're not going to run out.
Yes, I think that answers the question, because that's just right. The fixed percentage strategy is not what we're talking about usually with safe withdrawal rates.
Right.
Actually, the questions are flying in now, and I got to figure out where we were on the list here.
All right, I will
think
I'm looking for the word synthetic on this. Okay, the next question is, it's from Castles again. Thank you for answering my earlier question about inflation. As a follow-up, by how much would you immediately cut the withdrawal rate if inflation pops up, like a few years ago?
That's really an interesting question, and a tough question too. It depends upon how much inflation increases. You know, if inflation goes to 4%, it's a modest change. But if suddenly we're in 7 or 8% inflation, then you're going to have to look cutting back very substantially, maybe 20, 30%, to get your withdrawals in line, you know, with what's coming.
But my quick answer to your response is, but isn't that why you looked at the historical record and just maintain it? Because it's, you know, this is what's worked historically. And so the idea is it should work going forward. How would you, you know, why cut anything? Is just go with it, because that's what was studied to begin with, and it should work out at the end. I don't subscribe to that or not subscribe to that. I'm just curious what your interpretation is to that.
I would agree if you use the 4.7 safe withdrawal rate, the universal safe max I call it, which is the worst case for all investors over the last 100 years. But if you're taking out at a higher rate, let's say 5.5%,
okay,
it does not incorporate the prospect of a prolonged period of elevated inflation. So you need to make adjustments.
okay.
Yeah, that's fair. Okay, and then this is a more in-depth question. Tony asks, so in a richer retirement, you emphasize the importance of customizing withdrawal strategies based on individual circumstances rather than relying solely on fixed rules. For someone like me, retiring in 2025 with a mix of Roth assets, HSAs, and taxable accounts, how would you suggest integrating tax efficiency and sequence of return risk into a dynamic withdrawal plan that still allows for confident spending early in retirement?
That'd be a very complex question to answer, and I'm not going to really attempt to do it. I suggest that individual facing that situation needs to consult with a professional financial advisor to get full analysis of their situation, and get proper guidance.
And
okay.
This is a question then for both you and Wade, and it's when you're doing your research, because we get asked this a lot, and it's an important one about ordering taxes, ordering the sequence and the taxes. And when you folks are developing your research, it seems you don't even, taxes are just, you just control for it by saying we're not looking for it because of the nuanced approach, because it's so nuanced per individual cases, right? Have you, Wade or Bill, do you folks think about it like that? Like, listen, it's too complicated. I'm not going to concern myself with the taxes or the different accounts, tax deferred or so forth, because it's just impossible to satisfy everyone.
Well, can I answer? In my book, I analyze taxable accounts and the effect on withdrawal rate of increasing your tax rates. The higher the tax rate, the lower your withdrawal rate. Different correlation there, and that can be figured out mathematically without too much difficulty. Well, I don't know if that responds to the question, but
yeah. Just how you view somebody consider taxes when they're looking at this type of research, since the research usually doesn't account for taxes.
No.
Yeah, that's just with a Roth account, there are no taxes. With the IRA, you pay taxes out of the percentage distribution rule. We talked about earlier. With the taxable account, it's not the same story because taxes are eating away at the growth of the account over time. And you need to account for that.
Okay.
Yeah, okay, great. Next question. And actually, this question comes up quite a bit, and it's related to the tax question too, in a way, and rebalancing. So when calculating a safe withdrawal rate, are the percentages pulled evenly from a 5-fund portfolio? That's with the 5 different stock asset classes in the baseline portfolio. So are you pulling evenly from each of the 5 stock funds? I've always wondered, because obviously pulling from better performers and leaving a poor performer alone, I guess would work better.
Yeah, from my perspective, I use a total return approach. So I don't make distinction between whether income is generated from the portfolio from income, interest income, or dividend income, capital appreciation. It's all dollars, and they all mount up. And at the end of the year, there's a distribution made from the funds, and then that can be used in part to cover your withdrawals, which to a certain extent should be covered by your cash fund. That cash fund comes first.
But they're also getting at, if let's say you have 4 funds and one fund returned 100% for the year, and the other 3 are flat.
Okay.
Does that factor into your decision making from a total return perspective?
No.
Or you just do it pro rata across the 4 funds?
Because rebalancing to a certain extent will take advantage of that phenomenon and give you an opportunity to earn returns from classes that have not performed well and are probably about ready to perform well. So I wouldn't make an adjustment based on that.
Yeah, for the listeners who do like to get into the weeds on that, in your new book, you're using quarterly data, and then the baseline you rebalance annually. So if you're not rebalancing every quarter, how do you approach? Are you drawing equally from each, or do you, like what Alex said, drawing from the winner in that quarter with the 100% gain?
I'm not sure if there's a conflict there. I mean, rebalancing annually is just a process that you go through, regardless of what pattern you follow with respect to withdrawals. It doesn't matter whether you take monthly or quarterly or annual withdrawals.
Yeah, because wait, if the one that goes up by 100%, when you rebalance, they're all going to have the same amount of money in them at the end of the day.
That's right.
Yeah, after rebalancing.
Yeah,
right?
after
if you're not rebalancing every quarter. Although, I guess, is the analysis being done quarterly or just annually, but starting from each quarter? Maybe
I've
this
tested
is getting
it
too far
on,
into the weeds.
yeah. I've tested in the book. I test on a quarterly basis, to see how that looks, comparing 1 quarter, rebalancing 2 quarter, 3 quarter, 4 quarter, and not rebalancing all. And it turns out that probably the best approach for retirees is to use the 1-year rebalancing. It doesn't deliver the highest withdrawal rate in all circumstances, but then again, you can't predict the circumstances and the withdrawal rates from that. So in the vast majority of circumstances, annual rebalancing seems to do the good job. Good enough.
And then when you do rebalance, it really didn't matter where you were drawing from specifically, because after rebalancing,
Sure.
you end up at the same point. Okay. The next question, if microcap's not available, what asset classes might you consider to replace microcaps in that 5-stock fund portfolio you look at?
Tough to replace a high returning asset class like that, earning about 11% plus over time. They might consider opportunistic investing, like emerging markets, which are very cheap now, are likely to have comparable returns, I think, over the next 5 to 10 years. You might want to consider gold, too. I know it's done very well lately, the last 2 years, but the way our governments are spending, I think it's going to continue to do pretty well for a while.